You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program for busy financial advisors looking to find ways to incorporate options into their clients' portfolios, as well as for you clients out there who are looking for a new advisor and maybe want to know what option strategies and skills they should bring to the table. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. If you like this program, you're looking for more options education, well, we have a legion of programs for you. We have our brand new Options Playbook Radio that we do over there with our friends at Trade King. It's a weekly check-in into all of their great content with some basic sports metaphors thrown in there, offensive plays, defensive plays, that sort of thing. And of course, you can always check out our flagship educational program, Options Bootcamp. That's been running for a few years now. It's a pretty popular one as well. So check out both of those wherever you find this program if you'd like to dive even deeper into the world of options education. And joining me on the old Advisor's Option panel today, we actually starting off with a newcomer to the panel. We've had his brother on many times, but this is his first appearance. Of course, I'm talking about Rob Swan, the other co-founder over there at Swan Wealth Advisors. Rob, welcome to the program.
Thank you.
Like I said, we've had Randy on many times, but this is your first appearance. So really quick, why don't you run down your background in the space and how you found your way to founding Swan over there with Randy?
Right. So my background is actually as an aerodynamics engineer. I graduated from the University of Texas at Austin back in '89. I went to work at Boeing for a period of time and then set off and got involved in a software development company. Randy had been talking to me for years and years about what he wanted to do with his proprietary strategy, defined risk strategy, and asking me to come and join him. So eventually I came over. I thought I was going to be doing a lot of trading. Obviously, without a financial background, I have an engineering background. I came in, I had a lot to learn. Options were central in our strategy. I very quickly came up to speed and began doing most of the trading at the firm. quite a bit of a wild ride, learning the business, learning about options. But what I found was where my real niche is in doing exactly what I had been doing for 20 plus years, which was automating and eliminating manual steps in the process of any process, our trading, our maintenance, our cash management. We had a lot of moving parts, and one of the problems that we had is being able to actively manage a sophisticated option strategy across multiple accounts, across multiple platforms, different account types, regulars versus IRA account, complying with all the different platform requirements was quite a task, trying to use spreadsheets and things like that. So I did what I had been doing for the past 20 years, which was develop proprietary software in-house that allowed us to treat every one of our trades, every one of our groups of accounts as if it was a single account, and really calculate block trades and allocations that were accurate, that allowed us to really turn the ship and execute whatever we wanted to do in our strategy within a few minutes' time. That's allowed us to scale up. We're now, offering our strategy, across 3,000 plus accounts and multiple platforms, custodians, order management systems, very efficiently with a very small staff. And we have 2 full-time traders in-house. It's been primarily made possible by our sophisticated and proprietary technology that approaches everything as block trades. And so now I am at Swan, since we've brought on additional traders and operations, and as we've expanded, my role is overseeing the execution of the strategy here in Durango, operating as COO. I'm not doing the trades anymore, but I am sit on our investment committee and really ensure that we execute our strategy according to our rules, according to what we've been able to do over the past 17 years since 97.
So you're the evil mastermind behind the Swan proprietary systems. And Randy's talked about them many times, but he never said where they came from. So now we have the other piece of the puzzle.
Right.
All right. And also joining us, as usual, our compatriot there, the Director of Education from the Options Industry Council, Mr. Alan Grigoletto. Alan, welcome back to the show, sir. It has been too long.
No, and thanks again for having me, Mark. It's always a pleasure to be here. Looking forward to diving deep into the topics of today.
All right, and last but certainly not least, he liked it so much last month that he was just dying to come back. He is Joe Cusick, the Vice President of Wealth and Asset Management over there at MoneyBlock. Joe, welcome back to the show.
Hey, Mark, I appreciate it, and I'm looking forward to having a great conversation with today's guest, so this should be a lot of fun for all the listeners.
All right, great. With the team assembled, let's dive right on into our first segment, our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. Like the name implies, this is the portion of the show where we break down some basic options concepts, some option strategies and techniques that you should be aware of when implementing them for a client or when looking for an advisor. And, when we were talking about what to discuss on today's episode, we looked at the feedback we've been getting on the show and on all of our programs, not just this one, on the network and on the website. And clearly where we are right now in the markets is dictating a lot of people's thoughts and emotions right now. We are recording this episode, listeners, in early to mid-July, and all the markets are essentially pushing or at record highs. So as you might imagine, we're getting a lot of listener feedback right now saying, hey, how do I lock in these gains? How do I protect these gains? How do I use options to protect these gains while still perhaps retaining some exposure to the underlying? As you might imagine, that is an ideal use case for options. So we thought, given the preponderance of interest in that right now, we should revisit the topics of protection, perhaps with an eye towards protecting a specific or constructing a specific hedge to protect some specific gains in the underlying, because that's a position a lot of advisors are facing right now. They're very fortunate. A lot of their clients are sitting on gains and they want to keep those gains while also having some skin in the game. So it's time to, I think, revisit the world of protection. Again, if you want to take a deep dive into all these topics, we've hit on them all individually in the past on the program. I'll mention the different episodes we discussed them on as we get to each of these topics. But bear that in mind. It's going to be a bit of an overview today. If you want the deep dive dive into those earlier episodes or check out those other programs I mentioned as well, where we take deep dives into these topics. Now, let's outline a scenario that's probably familiar to a lot of advisors right now and asset managers. Let's say your client got into XYZ at 40 and now it's trading 50. So he's sitting on some substantial gains and he's saying to you, hey, I like these gains. I want to keep these gains clearly, but I also think XYZ has some more room to run. I want to stay in the game for a little while. I don't just want to sell. So that puts the advisor in a difficult position. What can he do? Well, that's where options come in. This is an ideal use case for options. So let's construct a little example, then we can dive into a little bit. Let's say in this example, again, XYZ is trading $50. Let's look out a few months. The 3-month $50 put trading for $3. The 3-month $45 put trading for $1.50, and the 3-month 40 put trading for 50 cents. And that front month, that very near term, $55 call, so out of the money call, trading for $1. Keep those levels in mind, listeners, as we dive in. Now, the obvious choice, the first choice when looking at any sort of protective strategy, is indeed the basic protective put. Alan, this is bread and butter for you guys over there at the OIC. I'm sure this is probably part of your introductory conversation whenever you go to a new advisor office or a new asset management firm to discuss options. So why don't you walk our listeners through the basics of the protective put strategy and how it could be implemented in this scenario?
Well, thanks, Mark. Yeah. You know, the protective put is just a very simple hedge. It allows the investor to maintain the upside, but gives them, if you will, insurance on the downside. And you laid out a scenario of different term structures. And again, an investor should speak with his advisor and say, you know, where are your concerns? Are they in the short term? Are they in the intermediate term? Or are they in the long term? And then accordingly select that put to protect that position. If his concern is only based around the near term, then you go with a near-term put, because that in that fashion you're not paying the term premium for that put over a longer duration. And of course, the longer and further out you go, you're going to pay more time premium for that put. However, you know, if the client wants to be protected on the long term and he's a little bit at ease with paying for a higher premium rate, then that is also a good solution. This gives the investor the upside, but then limits the downside. I think that's about it on the simple side. One thing I should add in is that we now have weekly options as well. So you can even slice and dice, if you will, your protection to a very, very short period of time if the client has real anxiety in the markets.
Right, those are great points, Alan, and you're right. In the scenario I outlined, I kind of looked more towards what the typical advisor would look for, a little bit longer term protection. But there are multiple options, pun intended, when you're trying to carve up and dice up that protection you want. If you are indeed concerned about a very near-term thing, like perhaps an earnings event, then a weekly or something like that would be an ideal scenario to use those very short-term type products. But typically, you know, when we're talking about advisors and protection, and we've talked many times on the show in the past, listeners, about things like theta and that time decay curve. Remember, the closer you get to expiration, the more theta you have going on, the higher up you are that theta curve. So if you're buying near-term, remember, they're going to decay pretty quickly. So which is why we like to focus on that 3 to sometimes 6 month range. The scenario we have here is the basic 3-month put. So again, just to keep it in the numbers we were talking about before, XYZ trading 50, your client wants to stay in, but also wants to stay long. In this scenario, we looked at a 3-month put trading at about $3. So he buys that put, and essentially you're done. He's protected for 3 months, and if the worst comes to pass, if the underlying does drop, he's essentially stopped out to the downside at the price of 47. So in this scenario, he's giving up $3 or roughly a third of those $10 worth of gains in order to stay long. So that's a value proposition he'll have to evaluate for himself, and you'll have to do it with your client. You have to sit down with them and say, hey, is it worth it to you to stay long to pay this amount? And then you can go from there. Now, of course, you don't have to just pay that amount. There are ways to mitigate the outlay, and that's where we get some of the other strategies that we're going to talk about. By the way, before we roll on, I mentioned we have discussed some of these strategies in more detail in the past. If you want to take a deep dive into the protective put, then I encourage you to go back to our episode of the Advisor's Option from February of 2012, where we explore the protective put in all of its myriad details and spend a whole hour on it. So again, this is just a cursory overview today. Now, if your client is perhaps rightfully outraged at those prices and says, hey, I don't want to pay that much for my protection, well, there are some ways to mitigate that. And one of the easiest and more straightforward is your basic vertical put spread. Joe, I know this is the strategy you've implemented many times, whether back in your previous incarnation over there at OX or now on behalf of advisors over there at MoneyBlock. Why don't you walk our listeners here through the benefits of using a put spread as opposed to just the basic outright put?
Sure, and as Alan had rightfully so talked about the fact that you're going to be putting out premium risk when you're purchasing these puts, and that goes along with any insurance product that you're going to go out and purchase. You're trying to mitigate risk, and that's going to cost you. And whether you hope that you never have to use it, but if you do, you'd like to be able to offset those expenses. And quite often with insurance, you're not able to do that. Well, when you're in with options, you can actually do it. As we all said, they're very versatile. And when you do a put vertical, as Alan said, you could structure it whether it's a weekly all the way out, as you were saying too, Mark, 6 months out. You can buy a put. Well, I hate buying options without getting in at a lower price than the prevailing market. And so, for example, in your example, if you paid 50 cents for an option, put option that gave you some protection, I want to offset that cost basis, so I'm getting in lower than 50 cents. How do I do that? I sell a lower strike put below it. And the strike that I'm going to select on the lower end is going to do two things. One is I'm going to get enough premium to offset a lot of that, mitigate quite a bit of that time decay component that we were referring to, as well as some of that volatility component. Because one thing that you're going to look at as you start to look at puts as you ladder out in the further months, I don't want to get too in the weeds, but skew is starting to really steepen on put premium. You're already starting to see investors and institutional investors start to go in and start picking up some of that downside protection. So that's increased the price of those insurance products. So I like to look at those out of the money puts and sell those against what I'm buying, because then my 50-cent debit turns into maybe a 30-cent debit because I received 20 cents for selling those puts. And the strike price of the put that I sold is going to be a level where I feel confident that the market is going to hold. That is an area where I think that you'll see entrance of potential buying for the case of a long stockholder who's implementing this particular insurance. And the big benefit, Mark, at the end of the day for both the investment advisor and most importantly the client is that they're mitigating that expense, because at the end of the day, you're eating in the profits. And our role as independent advisors, as reps, is to mitigate as much of those expenses. That's why you're paying us fees. And if someone can't do that for you, then you really need to reflect on that relationship, because at the end of the day, then it's just costing you money. So that's why we like to use that strategy, that put spread strategy, and you can align it with either a single stock holding or a core holding where you're doing it with index options or index ETFs.
That's a good point, Joe. I was talking to a well-known advisor who's been on this show in the past recently, and we were talking about advisors who don't use options and other firms that do different things. And he said, anyone can go out there and buy the put and put that construction on. What people are paying me for is to find ways to pay for that put. I thought that was a great point, because you're right. It is not simple, but it is relatively straightforward to come out and to put on the protection. But that's just the beginning of the process. And a really skilled advisor will have some of the ability to do, like we're talking about here, to find strategies to offset the cost. So you're not just coming out, like in this example, and giving up a third of your profits, listeners, just to have some protection. And Joe, you mentioned a lot of great points there, including the volatility skew. Listeners, again, this is just a cursory overview. If you want to take a deep dive into all things vol, then by all means check out our episode of the Advisor's Option entitled, appropriately enough, Volatility, from February of 2013, February of last year. And we dive into that. And of course, we always have our Volatility Views program. Comes out every week on the network as well. So a lot of ways to dive into and get your fix of all things skew. Before we move on, Joe, you mentioned strike price selection. That's also obviously a very important part of any put spread construction, choosing where what strikes to have. Obviously, probably the long part of the long leg of the spread is probably going to be around where the underlying is trading now for most advisors when they construct this spread. And a lot of advisors typically, I think, maybe to make the calculation easier in their mind, or just to make it easier to the client, or more straightforward, they will construct that short leg at the break-even point. So in this scenario, it would probably be a 50-40 put spread where the client breaks even at 40. That's where they have their gains. So they want to protect their gains all the way down to that strike, and that's where they'll write that short put. What do you think of that approach, or would you prefer to see a lot of advisors probably maybe think the way you were thinking and look at some of the flow and look at some of the skew and some of the other dynamics when they're constructing these spreads?
Yeah, I think ultimately at the end of the day, what you're trying to do is mitigate risk so that it fits your profile that you originally set up with the client. In other words, if you looked at the client and you said, with the way that we have our portfolio constructed, we shouldn't see, I'll use a non-industry term, we shouldn't see swag to the downside of our net portfolio, even in the worst case scenario of, X percent, let's say 6 to 10%. So basically, when you think about that, you're going to position that put, the long put, in an area where you're comfortable that that's going to meet the protection qualities, because at the end of the day, you're trying to protect your core holding, which is long, and you want to keep that long, for that unlimited, as we say in the industry, potential upside. So strategically, you're going to have to look back at what you set up as far as the objectives, or what the client can anticipate when you get into volatile market environments, when you're dealing with particularly a long-only portfolio. And so that really helps with strike selection. In your case, you're saying this client came to you saying that you wanted to maximize most of the value or capture most of the proceeds from the particular underlying that you're trying to hedge. Yeah, you could get more conservative and do an at-the-money put and sell some out-of-the-money puts against it to mitigate that expense. Again, that put that you're selling for a reason, that twofold: not only mitigating that entry price of the protection you're buying, but you also have a firm belief that the stock will, or the underlying that you're trading and hedging, is going to hold up there. And again, I mean, as you said, we're doing this in July. If you looked at the market the day that we recorded this, I think if you were talking in the morning, we would talk about we're in crash mode. And then all of a sudden, now that we're talking at the noon hour, we're out of crash mode and buyers have entered into the market. So I think you have to be also practical about all of this.
Yeah, it's always a balance for the advisors between, we could obviously take them deep into the weeds with a lot of the concepts we have here, like volatility skew and different ways to do strike selection. But also, at the end of the day, the advisors are busy. They have a lot of clients, a lot of accounts to manage. So sometimes it's a difficult balance to do things in the ultimate most effective way from an options perspective, and also from an efficiency perspective to handle all their clients. And so it's always that delicate balance. They could spend hours constructing each position, or sometimes they just come in and look at where the break even is, look at their clients' expectations, and kind of roll from there. It's always the battle we have when talking options with advisors, how much time they have to implement this stuff. All right, and moving on to the position that I've described in the past on this program and other programs as the holy grail for many financial advisors and asset managers out there. Rob, I know this one will interest you, so put your listening ears on. This is, of course, I'm talking about the collar. If you want to take a deep dive into the collar, listeners, then check out our December from 2012 episode of The Advisor's Option, entitled, appropriately enough, The Collar, where we get into all of the myriad aspects and benefits and downsides of the collar, including a lot of the great studies that Alan and the guys at OIC have done, looking at the collar and how effective it is in a variety of market scenarios, and comparing it to just being naked long the underlying, which is, at the end of the day, what a lot of advisors are doing in their client portfolios. So what is the collar again? Very brief overview. Collar combines what we were talking about earlier, which is, in this scenario, XYZ trading 50. You're buying that, let's say, at the money protective puts for, in this case, $3. That gives you 3 months of protection. Now your client is saying to you, hey, I'm paying roughly a third of my gains to protect this position. That seems like a lot. What can I do to offset that? And I also think XYZ is going to continue to rally, maybe 10% in the near term. So then you can use that information and say, well, there is a way we can offset that, and that is to construct a collar. And the collar combines that protective put with a position we've also discussed on the show in the past, the covered call. So in this scenario, now you have this long 3-month put, and you're going to sell a very near term front month in this scenario call, let's say 10% out of the money, because that's your expectation of what the underlying is going to do. And in this scenario, that front month call is trading for $1. So now, very simple math. You paid $3 for one, you collected $1 on the other, so you subtract one from the other. You net paid $2 for this position, this collar. So now what have you done effectively? Well, you're long XYZ underlying, so if it continues to rally, you get to participate in that upside all the way up to that strike where you sold that call, that 55 strike. If it gets up to that level and beyond, then you will sell that stock at $55. And you're okay with that because that's the expectation of your client. To the downside, what have you done? Well, since you've shaved $1 off the cost of that put, first off, you've cut a third of the cost of that protection just by writing that call. So that saves you premium right there. And also it increases your actual break even to the downside when you're talking about the put spread. Now you're stopped out essentially at 48 to the downside as opposed to 47. So it gives you a little bit better protection, and it also gives you saves you a little money in the process. You can see why the collar is a very attractive thing. Now, Rob, obviously you guys are kind of collar aficionados over there at Swan. You guys construct a variety of collars and overlays over there at Swan. Why don't you walk us through some of the more detailed aspects of the collar, why you guys like it so much, and why you think a lot of advisors should be embracing the collar?
Well, so I'm going to, if I can, I'd like to speak a little bit to the protective put. That's very important to us. One of the things that differentiates Swan is that we don't think of a long-term put as a 3-month option. We don't think of it as a 6-month option. We're more interested in something in the 2-year range. Be like airlines buying fuel futures. They're not looking to buy short-term risk, or exposure, protection. They're looking to hedge like health insurance, life insurance. We're looking to hedge something long. And if you're planning on holding a protective put constantly and never trying to predict when the markets are going to sell off, then you're going to want to basically buy the cheapest put on a per day carry cost. And the per day carry cost, because of the theta that you described in terms of the depreciation in the first year of a 2-year option, is much, much more stable. And so we could go buy a 2-year put at the money, and the implied volatility of that put is not really being affected by local market conditions. We could have a fiscal cliff or a flash crash, and a 2-year put is not going to have a volatility spike. You're not going to be stuck at the end of 3 months when the markets are crashing, having to re-hedge and buy something that is extreme volatility that has massive depreciation very quickly to where it's going to zero, and it's just a sunk cost. So I'm going to use an analogy like renting a car. If you were going to basically go out and you were going to drive your car 365 days a year, you probably wouldn't go to Avis and rent your car on a per day rental rate. You would actually probably do a longer term lease on that car, or you'd buy the car so you could drive it the entire time. And it's a much, much lower cost. When you're buying something that's that far out, it's got some significant intrinsic value. We're not just letting that go to expiration and go to zero. It's got intrinsic value at the end of its life cycle. If we try to roll those every single year, for example, then you still potentially have a significant amount of value left in that put, and we treat it like a very valuable asset class. When the markets sell off really hard, that thing is worth a huge amount of money, and we're able to sell that, collect the profits, and basically buy more equity at a lower cost. So we're decreasing our cost basis on the equity, and our clients actually get they start to call us and get excited when the markets are crashing because of the cash that they're going to be able to generate from selling that hedge and basically buying a new one at the money that's another, let's say, 2 years out. And so we treat that put as not a sunk cost, not like an insurance policy that's just throwing away premium, but as a very valuable asset. And we manage it that way, and we stabilize its cost by looking for much longer term puts. When we look at it that way over the course of the history of our strategy, until last year where the market had gone up significantly and our puts depreciate more than, because of being so much out of the money, depreciate significantly, our long-term put was not a cost to us. It was actually a profit to us. When you combine all the down years and the profits we made and all the up years since 97, we actually had a net profit on our put alone, which is completely counterintuitive to this idea that the put is so costly. It's very costly if you're buying really short-term options that are going to zero, but it's not so costly when you look at stabilizing those costs over a long time. So that's kind of a segue into how we view our put and our equity together, and we're managing it together. And yes, we want to reduce the cost of the hedge. When the markets are going up, you pay the cost of the depreciation of that hedge, and that's going to affect your upside capture ratio in your equity holdings. So we're looking at reducing those costs. And while we don't do a direct collar, we're actually looking at doing non-directional income trades that might be selling a strangle. And this is a short-term strangle because we want to be exposed in the short term. We don't want to have a lot of exposure to short-term volatility. So we're selling something that is going to depreciate fairly rapidly so that we could potentially generate income on a monthly basis, doing things like condors and iron butterflies and strangle. So it's not a pure collar in terms of us letting the stock or letting the equity price go up and breach our collar strike price. We actually are doing on a monthly basis multiple income trades to try to collect 0.5%, 1% per month in premium. That's going to help us to increase our upside capture ratio. It's going to help us in a down year to pay for any deductible that we may have in the hedge, because obviously if there's time value left, even if you're deep in the money, there's still going to be some value to that put. So there's going to be some downside deductible, if you will, on your protective put. So in the downside, we can help to eliminate our deductible. In a flat year, we can pay for the hedge and have somebody have that hedge the whole year for no cost. And in the upside, we get to increase our upside capture ratio. But what differentiates us is we're not managing selling a short-term call and then allowing the market to go up, breach that call, and basically just giving away all the upside in the market above that strike price. We have our own independent rules on that strangle, for example, or on that short call, to where we are looking for the market to stay in that normal range. But if it's starting to get close to where we're going to be giving away a bunch of the profit, we will go ahead and close that trade out, take a small loss on that particular trade, and then sell another one. So we're not looking at just trading away all the upside of the markets by selling a kind of a passively managed collar.
Yeah, I've often called it, with Randy, I've called it a collar plus, or collar with a kicker is kind of the way you guys do it. I'll get to the long-term put part in a second, but I like what you just mentioned. I was going to get to that next, is of course what you do in the near term to offset, again, some of that premium. I talked about the collar being selling the front month out of the money covered call, but you guys add an extra kicker component to it. Like you just mentioned, you turn it into a strangle. So you sell that out of the money covered call, and then you also sell an out of the money put. So essentially, listeners, what they've done is they have a bit of a short put spread to the down, a long put spread to the downside, and then a out of the money call against it. So they add an extra income component, an extra revenue generating component of the trade to again help offset some of the cost of that protective put. And that again goes back to what I was saying earlier about how the good advisors, the ones that are worth their money, are the ones who are spending their days not just protecting your assets, but finding ways to pay for that protection. And that's what you guys do over there at Swan. Now, interesting, Rob, you mentioned something that probably blew the minds of a lot of our listeners out there who are usually looking at very, very near-term scenarios in terms of protection and are getting a lot of pushback from their clients. I don't want to pay this kind of money. In our example, I use 30% of the profits, but it could be any percentage. And their clients are pushing back against paying for this stuff. And now you're telling them to go even farther out, 2 years. So that probably blew the minds, I would think, of a lot of our listeners. But you also mentioned an interesting scenario of how you manage that. Let's just stick with that for a second. In a typical scenario, let's say all other things stay equal, vol stays the same, and the underlying stays relatively flat, and you have this 2-year put, and let's say a year goes by. Is that your typical roll period at that point? Will you adjust and roll out another year after a year? Or what's your typical management scenario with that put? Let's say all other things being equal, you don't have a massive black swan event or a massive upside rally or a massive change in vol.
Right. So one of the things, if you're buying a 2-year put, you're not trying to lock in your gains every single day, every tick that goes up in the market, which if you do that, it's like buying a brand new car and driving it off the lot. Your depreciation, your delta on that new put at the money is going to keep you in the really, really low upside capture ratio. You're going to truncate away almost all of your upside gains. You're like last year, if you basically were trying to lock in every 3, 4, 5%, you would end up having a 5% up year and the market's up 32. That's not acceptable. So we look at trying to stay out of the steep
theta decay period of that trade. And so that's the second year. The first year is fairly stable. And given 1 year, we will then lock in gains in the market at the new upper level. So if we set our deductible, if you will, to have kind of a maximum 7% to 10% downside with some catastrophic crash, which kind of caps your downside, then, we're basically looking at each year ratcheting that up in the up years to where we're locking in higher and higher levels in the market. And now you've got a 7% deductible from that new higher level. And did we pay some upside cost in terms of the depreciation of the hedge? Absolutely we did. Our hedge got crushed this last year, but the market is so much that if your primary core holdings are a large portion, let's say 85, 90% in equity, then your 85 to 90% is getting the market returns and your hedge gets crushed, but you still have participated at a fairly high rate because we're not looking to re-hedge on the way up. We basically are looking at that as an annual hedge unless the markets are selling off significantly. And if the market sells off significantly, it's kind of like rebalancing like equally weighted sectors or something. If you have some sectors that are running, in this case your hedge is running, it's highly profitable. We don't want to let that profit slip away. So when we get down to the point where the hedge is covering 1-for-1 our equity loss, that might be in the 25% range in terms of the down year from that hedge strike, then we're looking at taking the profits from that hedge and buying more equity at that lower price. And it may not be the lowest price, but when markets are down 25%, it's a great deal to be able to buy. And most people don't have cash, but with the protective put in place and one that's not, let's say, expiring and worthless every 3 months to where you're having to insure your house while your neighbor's house is burning or get hurricane insurance while Katrina is still blowing strong, we have that hedge that we're able to sell, take the profit, buy more stock at that low price, and re-hedge. And because we're buying farther out, the implied volatility of that farther out option costs, it's definitely a higher cost than buying a short-term option. But if you look at the implied volatility 2 years out, it's not really all that concerned about a storm happening in Chicago when you're living in California. It doesn't get affected anywhere near as much as what you think, whereas that short-term option is just getting crushed. And it becomes so expensive that a lot of people are faced with going way out of the money, which increases their deductible, or they reduce the size of the hedge, and they're saying, well, my house is worth $100,000, but now I'm only going to insure it for $80,000. We believe in always being protected, always having the right insurance policy, and doing what you guys described in terms of these other income type of trades to help offset the cost, the upside capture ratio, to help pay for the deductible in a flat market to make that thing free if possible. And we manage those independent of each other. We have our own rules for managing the collar and the short put that we're selling. We're not just letting those things go in the money and truncating away all additional protection. Those things are managed in and of themselves on a monthly basis as market neutral, non-directional trades that we're simply trying to collect theta.
Great stuff there, Rob. And of course, I'm almost hesitant to bring up this last one, but since we are talking about ways to mitigate the cost of the outlay, one way that a lot of traders and a lot of advisors like to go to is, of course, the ratio spread and its alternative, the back spread. We'll get into both of those in a second. The reason I hesitate to bring these up, listeners, is because this is a strategy that could easily be put to bad uses if you aren't careful, if you don't have proper risk management. But that said, in the scenario we were talking about before, you've ridden your gains up from 40 to 50. The client wants to stay long. You could just buy that put for $3. You could buy that put and perhaps in our scenario, sell the 40 strike put at the break-even price, and that only nets you 50 cents in our example, so then you're paying $2.50 for that spread. But then you say to yourself, if the underlying goes back to these levels, perhaps the client is still bullish and wants to buy more. That might be a scenario then where you could write a second put on that strike, and that would be constructing a ratio put spread. So now instead of buying one and selling one, you're buying one and selling two. I think the net impact of that should be fairly obvious. You're now selling two, you're collecting twice as much income from that short leg of the spread. So now instead of paying $2.50 for that spread, you're down to $2. You've shaved a third of your costs away from that. Now, the potential risks of that, of course, are also readily apparent. You're now selling an extra put on that strike, so you're essentially naked short a put on that strike. So if the underlying does have a worst case scenario and drop back down to that break-even price, you are no longer protected. You are, in fact, once you get past that strike, starting to lose money. So something to bear in mind when you're constructing these. Joe, like I said, I hesitate to bring these up because they can be abused, but the ratio spreads and perhaps its light side cousin, the back spread, do have their uses. Why don't you walk our listeners through your viewpoints on these spreads and when you may choose to implement these?
Yeah, I think you bring up an excellent point that you have to understand the risk. But with the previous example of where, as an investment advisor, they may say after a pullback, I want to cost average into stock and take the proceeds from the put. Having that extra put there actually reduced on the ratio that you were just describing, where you buy one and sell two, for example. You could actually basically say, yeah, I'll take the proceeds of the long put working for me, so going from 50 to 40. But the beautiful part is that because you sold the extra put at 40, not only do you get to keep that $10, but you basically could say that you almost did that long put for probably pennies on the dollar comparative to buying them outright. You take that into consideration, you could be buying stock then, because if the stock goes below 40, you could be buying stock now, not at $40 on that short put that you're naked, but you could be buying stock theoretically at a lower cost basis, depending upon what else you did. But you could get it at below $40, and you're cost averaging in without even having to buy stock anymore. But with that strategy, Mark, you bring up a very valid point. If you're going to sell naked options, you have to be prepared to take on that obligation. If you do not want to take on that obligation, whether you're an advisor, an individual trader, do not do the strategy. That's my belief on it. That's how I approach it. But again, investment advisors are now utilizing that ability to sell extra units because they could look at their portfolio construction at that point in time after a pullback and say, stocks are cheap, I want to buy more, and I would love to buy some at this level. If I can get in even at a better level than that, well, I'll do that all day long. This is a great strategy that they could start looking at to implement. And again, what does that do? It does what they're getting paid to do, which is reduce cost basis on entry. And I can't stress that enough.
Alan, go ahead. You wanted to jump in.
No, I was going to concur with both Rob and Joe, is that having that short put, and certainly it ought to be cash secured if you're an individual investor. If you're a portfolio manager and you go the route of using this strategy, it's a terrific way to use it as a stock substitute. So rather than putting in your buy orders below the market at the strike price where you want to accumulate more stock, you enter into this ratio spread, and you're essentially buying where you want to buy or accumulate more stock. Essentially, it might be on a PE-based ratio. It might be on a dividend-based ratio. It might be on just, portfolio managers have to buy stock. If you're a pension manager, you have an obligation to continue to add to stock holdings, and it's a great way to do it at a much lower cost.
Great stuff. Joe, Rob, any final points on constructing hedges here before we roll on into listener mail? Maybe Joe, we'll start with you.
I just would make sure that any cash outlay that you are going to use for constructing in any kind of hedge portfolio, you try to mitigate that expense as much as possible, because at the end of the day, you're out there to make money for your clients. And that's the first and foremost thing that I would be thinking of when I'm constructing that.
Rob, same question for you.
Well, one of the things that probably deserves another conversation on another segment has to do with the tax efficiency. One of the things that's really somewhat counterintuitive is that if you are buying and holding your stock, give a year like last year where you've accumulated a significant amount of unrealized gains in your equity that you're not having to realize. There's no tax consequences. So in a year like last year, where your protective put is actually depreciating, and even if you are paying for that depreciation 100% from some of these income trades, you are very, very tax efficient. If you didn't pay for anything and you didn't make any income in any other short-term trades like the collars or the put verticals, selling these options, then your hedge depreciating when the market's going up you get to declare a capital loss, which is in a 32% up year like last year. You're declaring a capital loss. That is incredibly tax efficient. That is unlike any other strategy. And the times that you're getting big profits that you're having to declare, you're getting to write those off against your previous losses. But that's in your big down years. So while the markets are crashing and burning, your protected put becomes so valuable that you're able to sell that. You're able to buy the new stock at the lower level, reduce your cost basis. You're prepared for a subsequent bounce. You have all those extra shares that you haven't had to come up with any cash to be able to buy. Under that scenario, you potentially have a taxable event in terms of capital gains, but not in an up year like last year.
A great point. I think you're right, Rob. We probably could do, and perhaps we will do, an entire episode devoted to the tax consequences of a lot of these strategies that we're outlining on this show. So listeners, look forward to that. Meanwhile, we're going to keep on rolling right on into our final segment. Yes, it's time for you guys to join us here on the Old Advisors Options panel. It's time for the listener mail.
Listener mail. Listeners write in. Listeners write in.
All right, welcome to the listener mail segment. Like the title implies, this is the portion of the show where you guys get to sound off here. Join us with your questions and comments, just like our first listener did here, Mr. Tyler Madison. He's writing in. Everyone has open interest on the brain these days. A lot of people are writing in about open interest. He writes, I'm studying to become a CFA in Virginia. Well, congrats there, Tyler. He goes on to write, your program has been tremendously helpful in preparing me for any options components of the exam. It has also armed me with potential option strategies to use for my clients. Thank you for this great content. You could really charge for this. Well, don't give us any ideas, Tyler. He goes on to write, if I may, I'd like to ask a question about open interest. I see this mentioned quite frequently by options analysts. What impact does open interest play in the options market? Does an option with high open interest behave differently than an option with low open interest? Is this something I should pay attention to when trading options for my clients, or is this not important? Thanks again for all of your insight, Tyler. Well, great question, Tyler. Again, congrats on taking the exam, or I guess future congratulations on passing, hopefully. Glad we could help. That is the point of this program after all. And you do raise a good question. Open interest is very frequently cited and often misunderstood as well. We spend a lot of time dealing with it in Options Insider when we're looking at things like unusual activity. And it certainly has a lot of value, but it also sometimes can be, I think, overplayed as well. So let's dive into that. Maybe Alan, we'll start with you. I'm sure you get a question like this a lot whenever you approach new advisors and new firms saying, hey, what is the big deal with this open interest number? So why don't you walk us through your thoughts on open interest and how valuable it might be, and perhaps how it can sometimes be overused as well.
Yeah, that's a excellent point. I mean, there really is two parts to the question. How important is it to the average investor? To be clear, open interest are those options that are available for exercise. So that's exactly what that is telling you when you look at the open interest, is how many of those options are still available for exercise. It is not the same as volume. So, when you're entering into an option contract, looking at open interest doesn't necessarily tell you that there's not volume going on in those. There could be a very high demand for options and also sellers, but they just haven't found the price to meet. So it's not a liquidity issue per se. How much it makes an impact, the open interest, it can have a significant impact. If you have a high open interest and you're right at the strike price going into an expiration period, you have to be cognizant that there could be a lot of exercising for stock, and that can affect some of the volatility of the market. That's about the only thing. I think that's not something that the average investor need to be concerned with. I think, certainly he shouldn't steer away from entering into an option, a particular option in a particular month or strike, only because he doesn't see the open interest there. And I'll throw it out to my colleagues too, because they may also have some other thoughts.
Well, we're not paying attention too much to open interest, except for in answering questions in the scalability of our strategy. Obviously, if we are trying to buy some long-term put options and we represent 99% of the open interest in a particular strike 2 years out, then there's some question as to whether that presents a liquidity concern for us. We're nowhere near anything like that. There's huge open interest in what we're trading. I mean, doing SPY, SPX, extremely liquid markets. We're trading only in the highest liquid, options contracts that are available. But with that being said, we're more interested in looking at what the spread is. And we think that, very low open interest may increase the spreads, may make it harder for us to get somewhere in, kind of a midpoint value point. And we may have some kind of slippage in the options that we're trading, monthly for income trades. These are nearer term. There's huge open interest. And typically for an SPY option, we may be seeing a 1 cent spread. 1 cent spread is so liquid, we're able to trade extremely high quantities and really sell at the bid and buy at the ask. And there's really not much slippage. So we're not really concerned about it. We think the markets are very, very efficient in what we're trading. And the open interest, we think, will get into the spread when there's a liquidity issue. And if the spreads are reasonable for us, then we don't even pay attention to open interest.
Yeah, I think Rob and Alan hit the nail right on the head. Bottom line is open interest represents multiple participants, meaning someone other than the market makers, the liquidity providers, that offers the opportunity to get in at better prices and get out at better prices. And that's what it represents generally. And that's about where I would look at it. And I think it's been reiterated with the other comments.
Great stuff. All right, we have time for one more question here. This one comes from Jay Shaw, writing out of the Great White North, Ontario, Canada. He writes, can the Advisors Options hosts recommend any good listed products that generate options income? I like the strats you discuss on the show, but simply don't have time to manage all the strikes and such for my people. That gets back to what we were talking about earlier with the time management issue. He goes on to write, available in Canada is obviously a big plus for me. Thanks. Well, Rob, maybe we'll start with you. I'd imagine you might have a recommendation or two for our friend here, Mr. Shaw.
Well, we're typically looking for highly liquid options that have fairly tight spreads. I think that if you take something, if you were going to be doing strangles on Apple, for example, we happen to use SPY. We use the triple Qs. We use GLD. We use SPX. We use RUT. So we're looking for something that has very, very efficient markets, very tight spreads. And once you've chosen that underlying, you can really run, let's say, in our case, market neutral income trades, running iron butterflies, running strangles, doing iron condors. You can run those and manage those in exactly the same way, regardless of the underlying that you're using. And so I would just recommend choosing something that is very liquid, as evidenced by very, very tight spreads in the option contracts.
That's interesting, because I read this a little bit differently. I read this as he's looking for a product that will kind of do that and replicate that for him, kind of like a product maybe linked to the BXM or the PUT or something like that. Do you have any recommendations along those lines?
Are you talking about a particular product, meaning like a mutual fund product offering, or?
Perhaps.
Okay, well, a little plug for our own strategy. Our strategy is offered in both a mutual fund format as well as SMAs. Our mutual fund is tracking very well with our SMA performance because we're running the same strategy. So we have had a hard time finding strategies that are sophisticated, actively managed, that are readily available in the marketplace. There's a lot of passive. You've got things like the Gateway Fund. You've got a variety of other funds like that, but we find some significant flaws in, compared to what we're doing, whether it be the, buying the short-term options versus the long-term options, and then just allowing these options to be passively managed, letting them expire, letting them go into money in terms of the call and put writing that we're doing. So I would love to hear from anybody else, competitors that are out there that are doing sophisticated option strategies in a product like a mutual fund. I would love to hear that, but we haven't found any. That's one of the reasons that we launched our fund.
There you go. I lobbed you a few softballs, and you finally hit it out of the park. All right, Alan, any other suggestions here from Mr. Shaw?
Yeah, just a couple of thoughts. For Mr. Shaw, he may or may not be aware that Canadian investors can trade U.S.-based products. There isn't an issue with that, either in their retirement portfolios or elsewhere. In fact, most Canadian investors have a high degree of U.S.-based products in their portfolios because it gives them a greater and broader portfolio than what may be available in Canada. That being said, Canadian market has been very quick to emulate a lot of what's going on in the U.S., and so they have many optionable ETF-like products out there. In particular, the couple that come to mind, BMO and Horizons, are moving to the forefront with some of their products. May not have the sophistication that Rob Swan has, but certainly it's available to Canadian investors.
All right, Joe, give us your thoughts here for Mr. Shaw as well.
Yeah, no, I would reiterate what Alan just said. Take a look for the ETF products that are optionable, that fit what he is looking to fill a void on or an opportunity. You know, for example, you know, Alan mentioned one. Another one is if he's looking for something like something that has a high dividend yield. There's an ETF out there, VYM, which is a Vanguard fund. I'm not pushing Vanguard, but it is optionable, and it is an opportunity where, you know, if he's looking for large cap value exposure, and while he could also write options against the underlying every periodically, but this could be a nice addition to someone that's looking for that type of exposure. And there are so many of those products, but I think the critical thing that Alan just brought up, make sure it's optionable. That's the hard part with mutual funds. They're not optionable. So all the things that we talked about today, you wouldn't be able to do with a mutual fund, but you can with these ETFs. So that's where I would say Mr. Stevens should take a look.
All right, all great suggestions. Of course, if you want stuff that just does it for you, of course, too, you have the Swan Fund. You have the very much more basic stuff like all the Lipper and other funds that are linked to things like BXM, which, of course, write an at-the-money covered call in SPX and replicate the returns on that for your portfolio. So there are products out there. PUT also replicating the put rights, and there are various flavors of those, a few percent out of the money on each of those, at the money, etc. So you can find a flavor that might line up with your needs, and that will handle a lot of the writing and rolling activities that you may be concerned about having the time to do on behalf of your clients. So there are products out there. I just say just be cautious, once you get farther afield in some of these kind of esoteric structured products that attempt to replicate that, they will charge you very high fees. So be cognizant. Don't pay more in fees than you're getting out of value from the product. But a great question, Mr. Shaw, and good luck there implementing options on behalf of your clients. Unfortunately, that's all the time we have for the listener mail. It's also all the time we have for this episode of The Advisor's Option. But before we go, as always, let me check in with each of my cohorts here on the Advisor's Option panel to see what they have coming down the road that may interest you until our next episode. Alan, we'll start with you. I know you guys over there at OIC have been very busy. You just have a conference. You have a bunch of stuff coming down the pike. Give us a little hint, a little tease of what's coming down the pike over there from the Options Industry Council.
Well, thank you very much, Mark. We're now just pushing out for our schedule for the fall, where we'll be on the road educating investors across the nation and many cities coming to you. The best way to stay on top of that, of course, is to come to the Options website, optionseducation.org. Look at our schedule of events, and we encourage you to register. Once again, everything we do is gratis. It's free, so sign up if it's near a city near you. Thank you.
And Rob, I know you guys have been working on a lot of stuff over there at Swan Wealth Advisors, so why don't you give our listeners a bit of an update on those and where they can go to find out more?
Sure. Appreciate that. Our goal is to really offer our defined risk strategy on multiple asset classes and in multiple products. Ultimately, we want to offer our strategy globally. We have taken steps in that direction to not only be offering our existing S&P 500 base defined risk strategy, which has been in existence since 97. We're looking at rolling out an international version using EFA and EEM later this year. We're looking at being able to have a gold product that is defined risk strategy, running our exact same rules, exact same expected performance. And we're also have recently rolled out our defined risk strategy in Swan Re, which is a reinsurance product. Our whole goal is to really offer the same type of strategy, the same rules, our same proven performance and protection on as many asset classes as we possibly can.
That's interesting. I didn't know you were doing the overlay strategy essentially in the reinsurance as well.
Right. The reinsurance, that could be a whole nother topic, but the reinsurance, basically, we're able to write insurance, captive insurance mostly, that is fairly low risk, contractually capped insurance, take some corporate risk off the table for different companies, and we're able to take, let's say, $2 or $1 for every capital that we have that for our investors, and we're able to take that $3 now and invest it in our strategy with our proven performance, which provides leveraged returns, again, with our protection, with all the benefits of the tax advantages of being in a reinsurance product. So green light, Bree, Berkshire Hathaway. I mean, we're a lot of interest, a lot of activity in that particular area, and we believe that because of our returns and our low drawdowns, we believe that our strategy is a perfect fit for a reinsurance type of product.
All right, great stuff. And last but certainly not least, our guest co-host, Mr. Cusick. Tell us what's coming down the pike over there at Trading Block and Money Block.
Hey, yeah, Mark. I mean, Trading Block for our retail investors, we're going to be rolling out over the next couple quarters completely revamped tool sets and capabilities that are going to be rolling out very soon, and we're working very hard for that. For reps, we're actually working on two things. We're in beta release right now for a brand new group trade platform that's going to allow a rep to be able to execute a block order and have it deployed out to the various client accounts that they have and the allocation done too. So that's a huge step. We're also working down the road. We're going to be releasing, and this is in the works right now, where we're going to have a portfolio construction tool, and we're working towards a portfolio rebalancing tool that will not only rebalance equities, but it'll also rebalance options in those portfolios, and it'll do it in aggregate, something that's not out in the industry. We're extremely excited about it. And, like I said, we're working towards getting that done. Sometime in late 2014 or early 2015, our advisors are going to have that at their fingertips.
Well, that's exciting stuff. Like I said here, even on this episode, anything that could help automate some of the process on behalf of the advisors, make their lives a little bit easier, make it easier for them to implement these strategies and do it much more efficiently across all their client accounts is something that we're excited about, and know a lot of our listeners are excited about too. Great stuff. And on behalf of Rob and Alan and our guest Joe, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.